The Taxpert Trading Loss Analyser will help you to work out the different ways in which a client, a sole trader or partnership client, can claim loss relief for a trading loss of the tax year 2021 and or the tax year 21-22. Now, the reason for developing this trading loss analyzer is that the Chancellor has introduced extended loss carryback for sole trader and partnership losses as a result of COVID. And this extended loss carryback introduces even greater complexity into the decision-making surrounding loss claims. Of course, cash flow is all important, and we know that the existing trading loss reliefs under, say, Section 64 do give a degree of flexibility, but not enough to avoid sometimes the wastage, for example, of personal allowances. And this complexity is certainly increased significantly by the further loss carryback provisions that we now have. And so what I've done is program the existing and the extended loss carryback, and I've programmed it in such a way that you can pick up on many different combinations of loss claims and see at a glance what the tax and Class 4 national insurance implications are of making each of those combinations. And it is so complicated that even with a dozen or so pre-programmed combinations, I've included, and you might be able to see this bottom of your screen, I've included a DIY claims sheet so that you can input your own do-it-yourself claims, as it were. Now, what we're looking at on this opening screen is the user guide. And like the other Taxpert tax calculators, you can input the client's name, and then what we need to do is input, as we'll see, the income, trading profits, and then losses, and any other income for each of the tax years affected. And behind the screen, as it were, within this worksheet, what I've done is program it so that for each of the tax years, 2017-18 through to 21-22, the app will accurately calculate the Class 1 and Class 4, depending on the combination of income and losses that the client has. And this has made it a really quite complicated program, but the way in which I programmed it enables us to see at a glance what the effect on the all-important cash flow figures will be. Now, let's go straight away. The user guide sets out the various options, but let's go straight away to the analyzer page. And in the analyzer page, it says it's protected and cannot be changed. That's because I double-clicked on a cell that we don't want to change. But let me now reset everything to 0. It's already got some pre-programmed figures. And then every time I change anything, I have to click that recalculate button, because that's where in the background it's doing all the magic stuff, as it were. Now, John Smith, client code JS001. What we need are his trading profits for the relevant years and trading losses for the relevant years, excuse me, and then his other income split down into the categories that you can see. And let's suppose that in 17-18, he made 56,000 of trading profits. In 18-19, it had dropped to 15,000. And then 2019-20, hit perhaps that year by COVID, he made only 5,000 profit. And in the 2021 tax year, there was a tax loss of 20,000. And we could stop there and just use this app to look at the current situation in terms of what we know already, but we could continue and anticipate that for the tax year not yet ended, although of course the basis period might have been year to 30th of April 21, long since ended, but let's imagine that there's a thumping great loss of 80,000 in that tax year. And you might be able to see, depends on the resolution on your screen, that the losses for the 2021 tax year are in a purple color, and in the 21-22 tax year, they're in a blue color, and that'll help us to see how the losses work through when we look at the analysis lower down. Now, let's imagine that our client, John Smith, has employment income in 1718 of 8,000, possibly in the next year, 28,000. And of course, this could be rental income, interest, dividends. I'm not going to put in any of those. We'll just have the employment income, 24,000. No, not 24. How much do I have? 15,000 in 2021, and then 24,000 in 21-22, let's say. Well, we have completed the input, and you can see the total income figures at the bottom of each of those columns. For 2021 and 21-22, they disregard the losses. And what I'm then going to do, if I just move the screen across, is hit recalculate. But before I hit recalculate, notice that as with my other apps, I have got drop-down selectors for state pension age, because if the taxpayer, like me, has already reached state pension age, then class 4 will drop out of the equation. I've also included a drop-down for Scottish taxpayers, because of course we know that the Scottish rates are different. So if it is a Scottish taxpayer, click I for Scottish, and just to amuse myself, if it is I for Scottish, then it's I or nay for the state pension question. Only, of course, I and no for Scottish, because if you're not Scottish, it would be no, not nay. And the important point, rather than that, is that because of the complexity of this, every time we change any of the input figures, and as usual, the input fields are all the fluorescent yellow, as it were, we've got to hit recalculate. Oh, just before I hit recalculate, because there will be options where we carry forward some or all of the losses, we need to put in a percentage figure, let's say 25%, as the tax value of losses carried forward. It'll depend, of course, on what you think the likelihood is of getting tax relief on the losses carried forward at higher rates, or only part relief because it'll be covered by personal allowances, etc. And similarly, we need a figure for the class 4. Let's just put in 9%. Actually, no, let's put in 10%, bearing in mind the health and social care levy. But again, that's an estimate, and you might want to discount those for uncertainty and for net present value. In any event, the app also, of course, reflects the way in which losses that are set against other non-trading income under Section 64 in the year of the loss and or the previous tax year must also be carried forward and used against trading profits for class 4. So that's why we have that partly why we have that separate class 4 figure. Now, we've put in all of those income figures. I haven't yet clicked recalculate, but just before I do click recalculate, what will happen is that we've got 13 pre-set options, combinations of loss claims, and then option 14 is going to be the do-it-yourself one. But just looking here, and I'll enlarge it if I can, don't seem to be able to, on the screen, the options are to claim Section 64, that's the so-called sideways relief, for the current year and then the previous year, followed by Schedule 2 of the Finance Act 21, that's the extended carryback to year -2 and year -3, where it's against trading profits only. And we could claim that for the 2021 loss, and if there's also a loss in 21-2, then do it for 21-2. Or second option, Section 64 current year only, Schedule 2 for 2021, then 21-22. Third option, Section 64 current then previous, Schedule 2 for 21-2 first, and then 2021. And the particular point there is that the Finance Act 21 gives us the flexibility to do that. And it might be that by claiming a loss for the current year, 21-22, under the extended carryback, before claiming the extended carryback for 2021, you in fact leave more of the 2021 loss available to go back to 1718. So that could be advantageous. And you can see there are all the various other ones. Oh, down at option 7, I've got no section 64 and no schedule 2. Just carry the whole damn lot forward. And then option 13, or is it 14, is the do-it-yourself claims. Enter on the next sheet at your peril, because what you'll be doing there is entering a different combination, but at your peril, because you need to make sure that the different combination is lawful. Each of my combinations is, but there are others, and you might choose to do something else. Just before we click recalculate, quick reminder of the restrictions. And in fact, if I go back to my user guide, then I have listed the various rules here under the constraints. Remember that courtesy of George Osborne, well, there's no flexibility as to amount. If you make a sideways claim, it's all or nothing. But under George Osborne, the set off of sideways relief against non-trade income is limited to the greater of 50,000 and a quarter of your adjusted net income. And of course, I programmed that. As I've said, you can't reduce it to protect personal allowance, etc. Losses of consecutive years must be claimed in chronological order for section 64, so 2021 before 21-22. But then for extended loss relief, that's not the same rule. An extended claim may only be made for trading losses of those 2 years, and that then goes against the trading profits of the 2 earlier years before the year before the loss on a LIFO, last in, first out basis. And Schedule 2 claims can only be made if either no Section 64 claim is possible, because neither Section 64 year has any non-trade profits, or at least one Section 64 claim has been made. You know, do you carry all this in your head? I don't think I do. And then, of course, we've got the limit on Schedule 2 claims, limited to 2 million for each of the loss. Now, that limit is to the amount of loss that can be carried back against the earlier years, whereas the 50,000 limit is the amount that can be relieved in the earlier year, rather than the amount that can be taken under Section 64, so a bit different there. And you've then got the flexibilities in terms of Section 64. You can do 1 year first, then the other, or the other way around, or neither. And then Schedule 2, I've said you've got that flexibility, and that's what then leads me to all of the claim combos, as it were, and an asterisk there for the 2 where we do 21-2 first, where associated claims are made. Then the first claim that's made takes priority. So there's a particular administrative point. You cannot use the 21-22 loss under Schedule 2 before you claim the 2021 loss under Schedule 2 if you've already made a claim for 2021. So good luck with that. But now let's go back to the number crunching. You can see how comprehensive this is. Oh, and just in case I forget, I've included in that tab a link and extract from the revenues manuals on how all of these rules work. So you can look directly at the revenue manual. Now, we've got the figures. We've got the 2 losses there. We've got various amounts of income. Hit recalculate and let it work its magic. What it's doing is working through the tax calculations for each of the 5 years under each of the options. And if I just look at the tax figures for 17-18, you can see that all bar one of them will be 17,835. Option 6, interestingly, is 15,735. So the only combination that will get us, by the look of it, a repayment of 2,100 out of 17-18 is option 6. And without looking at it, I'll bet you that that's because under option 6, I'm delaying the 2021 extended carryback until after I've claimed the 21-22 carryback. And then we've got different figures for 18-19, some different figures I can see for 19-20, and so it goes on. But the interesting question is going to be, what are the total, and cash is king, what are the total tax and class 4 liabilities under each of those combinations? And the answer is those totals in that column there. the minimum of which, 18,965, is that option 6. So that option 6, if we want to minimize the immediate and I suppose maximize the repayments here, is to go for that option 6. But when we factor in the value of the carry forward, option 6 has a lower carry forward value. We'll see why in a moment. We'll be looking at the detail of it. And if we take mind you, those values are a function of what I've put in here. If I were to value the tax carry forward at 0 and the class 4 carry forward at 0, remember to recalculate every time you change a figure, then the carried forward figures disappear. And at that point, option 6 is definitely the best. But I do want to have the carry forward figures in there. They will be worth something, so let's put them back in. Don't forget to recalculate. And now let's have a look at the breakdown of what happens under each option, because this is what you'll need to look at to satisfy yourselves as to what's going on. Now, if I look at the actual, for the 5 years, the actual tax and class 4, and then knock off the value of the carry forward, what is the best result there? Well, we get down to 6,457, and that seems to be option 7. And option 7, I know, is no claims at all, just carry everything forward. But of course, if you do that, you're not getting any immediate tax refunds. So that is an interesting analysis. Now, let's have a look at it in a little bit more detail. Let's just reduce the screen size so that you can see what I've got here. Under option analysis, for each of the options, but you select them individually by either typing manually the option number, it's got 1 there, or you can scroll, and if I scroll up to 2, you might have noticed the figures changing. But anyway, there are 2 elements to the option analysis part of the analyzer. First, you can see what you might consider to be a traditional layout for working out the offset of the losses. And so for each year, I've got the profit figures, and then I've got the losses. And you can see here in 1920, I've got that purple 5,000. Remember, purple was a 2021 loss, another 15,000 purple down in 2021 itself. And blue, I've got that blue 15,000 that will have come out of 21-22, and so it goes on. And then at the bottom, and I'll just scroll to the right, you can see for each year, you've got the estimate. What it shows here, of course, is what those losses are. So in 1920, that's the year plus 1 loss. So that'll be the 2021 loss that will be carried back under section 64, presumably. And the 15,000 there is the year plus 3 loss. So that'll be a 21-22 loss carried back under the extended carryback of Schedule 2 Finance Act 21. So you've got, and then you've got same year loss and a year plus 1 against the totals. And then the reason, by the way, for that 5 having to go up there separately from being down in row 47 is because that feeds into the class 4 carry forward analysis. That 5 can't be carried forward under class 4. Whereas the same year losses, that 15 and that 24, those will be carried forward under class 4, even though they're being used under section 64. But you can see at the bottom, we've got estimated tax liability, estimated class 4 liabilities, and those then give me the totals. So that's how those losses are being used. But then you've got here the loss analysis. So the 20,000 under option 1, this is, I'm using 15,000 against its own non-trading profits, and then 5,000 against the previous year's trading. Both of those will be section 64. And the 80, I'm using 24 against its own employment income. 15 is being carried back under Schedule 2, and that leaves me a carry forward of 41. And the amounts that will have been used against trading profits are the 15 and the 5 from that purple analysis, and then the amounts being used against other income are 15. It's that 15, actually. That 15 was that one, and 24. But I've had enough of this of you. But anyway, you can see how I've got the additional carry forward for class 4. And that's then going to be valued at whatever your class 4 percentage valuation that you take. Well, that's all pretty complicated. We're about there, actually, but let me just show you. If I were to select option, I don't know, let's go for option 8, then the figures all change. And by the way, at the top here, it tells me what I'm doing. Here, I'm doing section 64 in the current, then previous year, schedule 2 for the 2021, but not for 21-22. So there'll be a lot more carried forward on that. But if I then select the optimum, which I think was my option 6, you can see you're getting more carry back. We're doing section 64, previous then current, schedule 2. I'm doing 21-2 and then 2021. So that is the optimum in terms of immediate cash flow, and that was helpful. Option 7 was where we had all of it being carried forward. So no losses there, none being used up, the whole 100,000 being carried forward. And it shows you what the tax bills are in each year and so on. And that's it on the analyzer, except to show you the very dangerous DIY claims sheet. And I haven't formatted it particularly. Again, you've got the yellow highlight cells are the ones that you now fill in. And what I've given you there is pre-populated with the income figures, as you can see, and then you have to decide what to do with the losses. And let's suppose that what you decide to do is carry all of that 20,000 there back to year -3. Then it will let you do that. And indeed, if I then want to carry the 80,000 back to its year -3, it'll even let me do that. However, I'm wrong to do that because both of those are against the rules. That 20,000 going back from the 2021 loss all the way to 17-18, you're not allowed to do unless there's at least one section 64 claim. Now, what I might have wanted to do is a section 64 claim. So let's now reset those losses. If you click that, it'll just clear your nonsense. Here's a variant that would be acceptable. What I could do is claim section 64 out of the 20,000 against 1920. So that would give me, oops, shouldn't have typed it in there, should I? What I want is it actually against 5,000 of the trading profit in year -1. So that 5,000 you can see there, and then 13,000 against the year -1 non-trading profit. Now that is an allowable section 64. And once I've done that, I would then be able to carry the 2,000 back, but I have to do it against year -2. And I do now have an allowable combination of losses. If I then look at my analyzer and remember to do recalculate, that may well give me a different overall result again, probably not a particularly helpful one. But if I look at, let's have a look at option 14 is the do-it-yourself, and you can see there that the total cash flows are 26,863, which is the highest apart from carrying forward the whole lot. So it is different again, but it's an unlikely one that you would do. But you can see what I've done there. I've pre-programmed 13, or is it 12, of the most likely combinations that allowed you within the DIY claims worksheet to do your own. But you need to make sure that you're following the rules when you do your own. When I first programmed this spreadsheet, it had nearly 1,000 worksheets because I was doing 5 different years with 12 different options. And for each tax year and each option, I have to have 12 different spreadsheets to allocate allowances and reliefs in the tax optimal way. It's the old exclusions problem, section 25, etc. And it was only by resorting to a bit of Visual Basic programming with my recalculate button that I managed to work out how to get it down to 100 odd sheets. It's pretty complicated behind the scenes. Let me just, for those of you who have Scottish resident clients, have a look at it. If I actually, let's do both. Let's make them Scottish. That will change their tax calculation. And let's also make them of state pension age, and that will get rid of any class 4 liabilities. And if I recalculate, then, well, I should have highlighted one or two of the tax figures, but those tax figures have gone up now for some of the Scottish taxpayers in some of the tax years. And the class 4 liabilities, if I go down to the bottom, interesting that I've got one there. So there's probably a bug somewhere. I haven't zeroed it for 17, 18, but the other class 4s have gone. So, oh, no, it isn't. I think it's because I said, did I say nay? So not state pension age, so it's not a bug. And I had tested it. I know it's not a bug. I want a state pension age. With a bit of luck, the class 4s will have gone, and indeed they have. So class 4s have gone. If you're still there and you've not gone, thanks for watching. Have a go at it and email me if you've got any questions.